I think that our ability to predict value over the long term in commercial real estate is still at the very beginning stages. The algorithms and other tools that we use to predict the movement of people, the creation of jobs. There's so many variables at play. I'm saying you can't put them all into a spreadsheet.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Welcome back to the show. I'm your host, Todd Dexheimer, and excited to have Spencer Levy. Spencer, how are you doing today?
Doing great, Todd. Thanks for having me.
Yeah, well, appreciate you joining the show. I'm really excited to dive in. So, Spencer is with CBRE. He's a global client strategist and senior economic advisor for CBRE, which CBRE, everybody, I think listening probably knows, but in case you don't, it's the largest commercial real estate services firm in the world. And so Spencer deals with focusing on client engagement, public-facing activities, such as podcasts, including a lot of thought leadership. So I kind of hear you in a lot of places. I know you speak at a decent amount of conferences. You are on, some of the national networks, the Bloomberg and the CNNs and the Fox Business and things like that. So you're also part of the Weekly Take, which I listen to here and there as well. So really good information you're always able to give. So Spencer, again, welcome to the show. Really appreciate you joining us. The first thing I want to talk about is to just talk about kind of what's been going on overall in the market. In the market's a big word because we're talking commercial real estate. So, multifamily and industrial and retail and so on. But deal volume overall is down considerably. And I know a lot of brokers, including brokers with CBRE, didn't have great years in 2023 and 2024 compared to years previous. And buyers such as myself didn't have great years for buying either. So what are you seeing right now in the market? What's your take on kind of what's going on today and how you see that playing into 2025?
There was a famous political commentator named James Carville, who is Bill Clinton's political advisor. And he had a quote that I've been saying a lot recently. And his quote was, he was asked, well, if you could be anyone, who would you be? Would you be a famous ball player? Would you be the president? Would you be a king? He said, no, I'd be the bond market. Because if I was the bond market, I'd be the most powerful entity in the universe. And I think that is a very good way to describe what's going on in commercial real estate today, where the bond market is the ruler.
Yeah.
They're the ruler of everything that we do. And you sometimes say, well, the 10-year treasury and the short end of the curve, the market will adjust to those types of things. Well, it will eventually. But what we had was such a massive and rapid spike in interest rates starting in 22 that the market hasn't adjusted yet. And it hasn't adjusted yet because you went from a floor of basically 0% interest rates to 5.5 on the short end, now going down a little bit more. And the 10-year similar from under 1 to over 4.4, and that really chilled the market. So that's the headline. That's the beginning and the ending line of what's going on, which is the bad news. The good news is the market is beginning to adjust, and the market is beginning to adjust, starting with the debt markets, where because the short end of the curve has come down, likely to come down by 100 basis points this year, maybe another 50 to 100 next year. You're going to see significant improvement in financing terms. And that's going to lead to more deal volume. Where the game is being played, though, in terms of the valuation of real estate, it's really two things. So cap rates are overused, but what a cap rate is, it's a combination of yield and growth expectations. And values are based on yield as a difference between that and the 10-year treasury, which is the risk-free rate. Risk-free rate isn't come down that quickly. And so because of that, cap rates are likely to stay higher than we expected for a lot longer, including in places like multifamily, which I know is one of your areas of specialty, Todd. And you're not going to see nearly as much transaction volume. You're not going to see nearly as much building
Yeah.
because the cost of labor is high, because the cost of materials is high, and because the cost of construction debt is high. So the market's going to get better in 25, but not as quickly as we had anticipated because interest rates have stayed a lot stickier.
What about distress in the market? You heard distress is going to happen, and all these properties, these, especially the bridge debt, the CMBS even, and they're all, they're all coming due. All now we're in a higher interest rate environment, so nobody's going to be able to uh, pay their mortgage. Nobody's going to be able to refinance. Nobody's going to be able to sell if the market turns. And so we haven't really seen much for distress. Certainly there's some, but those are outliers. I just heard the other day from somebody said, we haven't seen the distress because it's been kicked down the road, but it's coming in 2025 and 2026. So look out.
That's a very interesting statement because I am a student of the global financial crisis, which I lived through. And it was always next year. That's when all this distress is coming out. That's when they're going to stop kicking the can. I don't believe that. And the reason I didn't believe it then, maybe I believed it then, it didn't happen then, and maybe I don't believe it now, is because the reason why you haven't seen it yet is primarily related to two things. First, the regulators have been very patient with the institutions that are holding loans disproportionately in the office sector that are distressed. And they're allowing them to mark them down for the last couple of years so that they can mark them to what is closer to market. And they're also waiting for interest rates to improve a little bit so values can get supported. And they're also allowing the banks to reserve against it. So the biggest institution that would likely be holding distressed opportunities, the banks, are getting to be in better and better shape. The money center banks are fine, by the way.
Yeah.
It's the regional banks where if you were going to see problems, that's where we're to be. But even there, they've written them down, have capital cushions now that have really, really helped. No, look, we're not going back to the RTC days of the early 1990s, where what the strategy of the authorities was then was liquidate, get out, move forward in a very laissez-faire free market capitalism moment. We're past that. And the reason why we're past that is I think that there was a complete mind shift change in the global financial crisis because Ben Bernanke, who was then the Fed chair, was a student of the Great Depression. And that's actually what he wrote his PhD thesis on, if you want to go really deep on this. And because of that mind shift change, we are far less laissez-faire than we used to be. And the government's going to do whatever it can to preserve the institutions. Now, there are some real downsides to that. And the downside is that we don't have a market clearing event, number one. Yeah. And number two, I think it slows the overall growth trajectory of the economy to keep bad assets, bad loans on the balance sheets of banks. I think the most efficient place to hold any asset is in the hand of a profit-motivated developer, because that's where you're going to get people taking risk to add value for themselves. And as Adam Smith said, unleash the animal spirits. No, that wasn't Adam Smith. That was John Maynard Keynes. Forgive me for misquoting two of the world's greatest economists.
I was sitting on a panel. I think it was about 2013, 2014. And I wasn't on the panel. I was sitting listening to a panel. And it was all these REO agents selling, single families and, small, 1 to 4 family buildings. So that's where all the foreclosures were, right? And they were asked, what about all this shadow inventory? And this several of them said the exact same thing. Well, the banks are kicking it down the road, and we're going to see an explosion of foreclosures that are going to hit the market, and you will see something like you've never seen before. You thought, 2009 through 2011 was bad. 2014 through 2016 is going to be even worse. And it's exactly what you just said. Like, that didn't happen. That never happened. But everybody kept on thinking, well, everything's getting kicked down the road. Shadow inventory. I kept on hearing that word, shadow inventory, shadow inventory. So interesting take that you said. I appreciate the insight there. You mentioned earlier, well, macro and microeconomics. So what do you see in the macro economy, what is the opportunity? Where should people be looking, in your opinion? Or where do you get excited about, I guess, in just the overall macro economy?
So what I look for our clients' investable opportunities is try to find those areas which have the greatest amount of economic activity. Okay, so it's not a very complicated thing. Like, where's stuff going on is what I'm looking for, and
Yeah.
how do I find it? And I find it first by starting very big picture. Well, what are the big picture trends that are happening here? And big picture, the two big picture trends I point to is number one is the reshoring of manufacturing to the United States, and I would say to the Americas, because quite a bit of it's going to Mexico and Canada as well. The other is the shift of the economic nexus of activity within suburban and some urban environments from the CBDs to live, work, play neighborhoods, basically tertiary locations within urban environments or newly built suburban environments, which are purpose built to create that nexus of activity by having mixed use developments of retail, office, multifamily, all under one roof. And you see this everywhere. And the question is, how big is it and why should you care? So I use this case study all the time. And I say this with a little bit of humor because I'm sitting here doing this interview today in Ann Arbor, Michigan, as my son is a junior at University of Michigan, and I'm about to drive him home on Friday. But this is about Columbus, Ohio. So some love for my Ohio State friends. New Albany is where Intel just put its new chip plant. And next
Yep.
to its new chip plant, they put several new data centers and several
Yeah.
office buildings and retail, and multifamily is coming in and near that to house the workers. And that's to me a massive trend, particularly in multifamily, because we are housing starved every which way from Sunday, and going to the places or pertinent to those places where people can live, work, and play, to me is a no-brainer. Now, why is it a not quite a no-brainer? I'll tell you why. Because even though you can get superior yields there, higher cap rates, lower costs of construction, institutions are still afraid to go to second or third tier markets, or what it's considered to be second or third tier, because they're not going to have liquidity on the back end.
Yeah.
Which to me is the opportunity for high net worth individuals or smaller developers to go into the hit it where they ain't. And because those are the places you're going to get superior yield from CBDs or live, work, play neighborhoods in major markets. Now, I think that it's also important for the another mega trend, which we started today's discussion with. If we're entering into a higher interest rate environment indefinitely, you're not going to see your returns coming from cap rate compression. You're going to see your returns disproportionately coming from cash flow. And so when NCREIF, which is a big industry organization that measures core returns across a variety of funds, when NCREIF looks at returns in all asset classes, including multifamily, they break them into its two components: return from cap rate compression and return from cash flow. And historically, over the last decade, until maybe 2 years ago, 70-80% of your return was from cap rate compression. And now I think it's going to reverse to be 70-30 income rather than cap rate, which to me should screamingly open the doors to what are some of these secondary locations. As far as the live, work, play locations within city centers, I think there's really two live, work, play. One is within city centers, at like a Fulton Market in Chicago, a Wynwood in Miami, a Century City in Los Angeles. But then there's also new developments outside of city centers that has all these things. And why are you seeing more of them, like a Lake Nona in Orlando? Well, because it's easier to build there and it's under control of one developer. And you can create this live, work, play environment that you'd love to create in an urban center. It's just very, very difficult to do it there.
Yeah. Yeah. You mentioned on the micro, and we're diving into micro quite a bit. By the way, that Columbus area that I drove through there, it's amazing how much building there is happening, and it's data center after data center after it's in so much industrial. I don't know if you've driven in New Albany and driven in there, but
I have.
yeah,
I've
and
never,
there's
and I've never
farms all around
developed.
you,
Yeah.
and then all of a sudden you get to kind of to the headquarters there, and that's
This brings up a broader point for our listeners today about why I like real estate. because I like real estate because you can see it, you can
Yeah.
touch it, you can feel it. And so every city I go to, I do the same thing. I stay in a hotel and I pick a dinner location a mile or two from my hotel. And then I walk there for
Mm.
dinner. Why? Because the only way you're going to understand real estate is by kicking the bricks. You got to walk the
Yeah.
streets.
Yeah.
And
Agree.
by doing that, you'll say, there's a great opportunity here, or maybe there isn't an opportunity here. And I'll give you, there's positive and negative here. So the negative is this, is so a lot of talk today, and I'm sure it'll come up on this call, is what do you do about these old office buildings that have lost their economic value? And my answer is there is no great answer because I walk the streets of just about every city. You see block after block after block of dead office buildings that were dead
Yeah.
way before
Yeah.
the COVID crisis. And it's because it's so expensive to convert them, which is why, unless we have a massive call to arms of let's solve this problem, you're going to be dealing with zombie buildings in a lot of downtown areas, in a lot of cities for decades, not for years, for decades.
Yeah. It's so hard to solve that problem. They're not built to be converted to anything. They're built for office, and most of them, right? Some are easier than others, but most of them I've looked at a few of them. I'm like, this would just be, it's more expensive to convert this than it would be to tear it down and build something new.
And
So
one of the tragedies of that, tragedy is too strong a word, but one of the really unfortunate things is when you look at sustainability as a measure of success, there's nothing greener than reusing an existing structure. The problem is the cost of converting that structure, irrespective of sustainability, is extraordinarily expensive. But
yeah.
then when you layer in some of the local regulations on it, it makes it mathematically impossible to convert it. And so what I think we need to do on sustainability front is we need to change the way we look at it. Most sustainability laws are written towards emissions, the amount of energy you use, the amount of waste you produce. And I think you need to get some credit for embedded carbon, for the carbon that is existing in the existing structure. I think that should be a big part of the solution to
Mm.
saving some of these older buildings, because if you put them to whatever might be modern emission standards, they're never going to get there.
Yeah. Yeah. Very true. I like how you said you stay and you walk. One of the things that I do, especially in a new market, if I haven't been to that market before, I like to run, and so I'm going to go for 5 mile run or whatever around the area, and you just get to see so much more doing that. You're slower, you're going slower, and you're just seeing so much more. One of the other things I like to do is if I'm going from my hotel to a property across town, or even to two different properties. However I'm traveling, I'm not taking the freeways most of the time. I'm taking the back road. I'm taking the slowest way there. And I have learned neighborhoods by doing that so much more than if I would have just taken, because you take the freeway, you just don't get to see what's going on.
It's by the way, I know this is a show about commercial, but it's very good for single family as well.
Yeah.
Where if you want to see, like, well, do I want to rent a house here? Do I want to buy a house here? Want to get an apartment here? Walk them, run them, whatever you prefer. But that's the only way to understand a city.
Yeah, you really get to dive in. What do you like in today's market? Industrial and multifamily were the hottest thing, in, I mean, for a long time, I guess, 2017 through, really 2022. Um, where, what's hot today? What are you seeing as investors really liking and trying to go after? What's the flavor of today? And if you could pick a flavor of the future, is there one asset class that you like more than another?
So today, putting aside the four major food groups, uh, office, industrial, multifamily, retail. And of those four major food groups, you did point out correctly that industrial and multifamily have been the hot asset classes. That I would say retail has and is increasingly getting a lot more institutional support.
Mhm.
The sub asset classes that are hot today are led by data centers and then SFR, BTR, single family rental, build to rent.
Yeah.
And those are getting a lot of love for a couple of reasons. One, on the data center side, has the benefit of both strong demand for data centers from big tech companies because of AI. The new administration is very pro crypto. That uses a tremendous amount of computing power. And you're seeing a lot of that product being put not just in the usual suspect areas, but they are going to places like Columbus, Ohio. They also are going to other places in the Midwest that have an abundance of power and water, because that is going to be the limiting factor when you're dealing with new data centers in some of the high density places like Northern Virginia, Dallas, San Francisco, and the west side of New York. But the SFR BTR is an asset class that is extremely popular, but that's really popular among investors, not among the government. The government considers it one of the most disfavored asset classes. And reason being is they don't like institutions buying SFR because they believe it raises the price of a single family home. But unfortunately, we're dealing with a dynamic now where a disproportionate number of Americans are locked into low interest rate mortgages and are not going to like just sell their houses. That the only real alternative, if somebody wants to live in a housing unit versus an apartment, is to rent for many people. And it's a terrible thing. It's a terrible thing. It's the fault of, I mean, fault is the wrong word, but it's because interest rates are so high. We're seeing this rents go up. We're seeing impossibility of buying houses. And unfortunately, if you take a look at actually the inflation numbers, the area that's stickiest is housing because of the high interest rates. So it's sort of like a catch-22. Well, if we lowered interest rates, inflation would go up, but if we lower interest rates, housing costs would come down. And so, which way do you want it? I mean, I think there needs to be, so when the Fed is making its decisions on whether or not to lower rates, they say, well, it's all inflation. Well, part of the inflation is the fault of high interest rates, particularly in the housing stock. So those are the two hot subsectors. But I get the question all the time: if you had $100 million, what would you do? I would be buying and building as much housing as I can across the spectrum of quality. And I would say this is from the Class A stuff, but I would be focusing my efforts down the spectrum, all the way down the capital A affordable, because we just have this desperate need for more housing. So from a demand side, it is a black and white case. But from a finance side, we've got these 2 or 3 entities out there known as Fannie Mae, Freddie Mac, and HUD, which don't exist for any other asset class. And here's the rub of it. They give you basically the same pricing for a loan in a secondary or tertiary market as you'll get in a major market.
Yeah, it's amazing.
It needs to be that to me is the single biggest exploitable, and I don't mean that in a negative way, but inefficiency in the market that I would be putting my bottom dollar on, but particularly in these neighborhoods that I just suggested, the neighborhoods which have new economic nexus of activity, whether it's near manufacturing zones or some of these live, work, play areas.
That very, very interesting. I think, if you had $100 million or more, housing is a huge need, and especially like you said, affordability. Affordability is really huge. I mean, I don't know how you solve the affordability issue. I mean, you just got to keep on building. Well, that's one big thing, right? We've seen some of these markets where they keep on building. The prices are now going down a little bit, but how do you build enough affordable housing? How do you put enough affordable housing into the ground? I don't know if there's an answer. Maybe
there's no great answer to it, and I'm not. Even though I'm a big supporter of housing vouchers, Section 8 and the like, and other things that can make housing more affordable, even those cause distortions in the market. I think that new supply is the only solution, but there needs to be government incentives to do it. So the math of building that new supply affordably is no worse than equal to the math that would build something that's market rate.
Yeah. We were looking at a redevelopment of an apartment building right now, and there is some available money for us to be able to do some renovations to it, but they want us to do 60% AMI. Well, the problem is the amount of money they're trying to give us it doesn't do us any favors. It actually makes it less profitable, a lot less profitable. In fact, where the numbers just don't work if we were to take their money. And so it has to work obviously both ways. I thought it's interesting how you said interest rates rising. I have a different take on the interest rates and affordability for single family houses, and probably similar to what you just said. But I think because interest rates were held so low for so long, that caused the extreme run up in single family homes, and that's what was the problem, is that we had low interest rates. Not that we have high interest rates; it's that we had low interest rates for so long that actually now we're stuck in this environment, and do you lower interest rates and spur inflation but housing growth, or do you keep interest rates high? And I think we put ourselves in a really bad spot by having these really low interest rates for a really long time.
Well, I think that you're correct from a big picture point of view on housing. That led to a massive distortion in the market, which
Yeah.
has now locked people into their homes. Because if you take a look at the average homeowner, the two greatest sources of their individual wealth are the equity in their homes and their 401k balance. And so those are things that the Fed looks at and say, well, what are we going to do to get it? We're not going to bankrupt, so to speak. That's the wrong word, but we're not going to make poorer the average consumer, willy-nilly. We're going to do it in a way that has to be tries to preserve wealth while we are opening up the American dream of home ownership to everybody else. And it's a very, very difficult balance. I mean, if you take a look at the distortion in the housing market that happened in 2007, and there have been books written on this, there have been movies about it. The Big Short was about this.
Yeah. It's a great movie.
Yeah, very good movie. But what it was about was when they opened up the financing standards too far into subprime, the home ownership rate in the United States went up by about 10%, went up from like 57 to like 67%, right?
Yeah.
And the good thinking macro thinkers said this is a good thing. People owning homes is a good thing, and it's going to help communities, and it's going to do all these other positive effects. And generally speaking, that's correct until you got to pay the mortgage. And then that's when the world almost came to an end. The world almost came to an end financially because of one bad assumption in a model. The bad assumption was that the average price of a single family American home could never go down. Because we made that one bad modeling assumption, the financial world almost collapsed. And it would have collapsed but for massive government intervention.
Yeah.
Okay. So, yes, I'm agreeing with you. The low interest rates for too long caused this massive distortion in the housing market that unfortunately is going to take a very long time to unwind. And putting new supply on the market isn't easy, given the restrictions you just laid out for a segment of it, which is to try to build more affordable.
Yeah. Yeah. And with the cost of building and the cost, of course, again, now of interest rates, that's a really hard thing to do. It's not getting cheaper to build. I mean, I'm friends with several builders, several subcontractors. It's not getting any cheaper for them to build, and I don't see that changing anytime soon.
Well, one of the challenges is labor. I mean, there's a shortage of labor, and because we have this building boom now in manufacturing and data centers, the same person that swings a hammer in a data center or a manufacturing site could swing a hammer on a housing project too. And so it's competition for that labor is a big challenge.
Yeah. Yeah. And I used to be a teacher. I used to teach industrial tech. So I teach a lot of these kids on how to get into the trades. And mom and dad, and I don't know if it's exactly the same still, but it's quite a bit the same. Mom and dad did not want their young Jimmy to become a laborer of any sort. They wanted, Jimmy to become a lawyer or a doctor or something like that. And so I think there was very little push. I know there was very little push to have kids get into the trades. And it was almost it was a bad thing. Like, my kid's dumb if he's going to go into the trades. Now that has changed quite a bit, but it's still not there.
Well, I think the perception again, distortions, right? Distortions are caused to markets by financial intervention. So it's easy to say, let's give more housing aid, let's give more financial aid for colleges. Well, I would argue that because financial aid became too liquid for colleges, it did two things. Number one, it materially raised the cost of college education because there was cheap money available. And second, it saddled so many of these kids with terrible debt they're never going to get out of.
Yep.
And it's
In
just
careers that they'll never use.
yes, it's a terrible, terrible thing that was caused by good intentions.
Yep. Yep. How should investors approach risk management, thinking about the uncertainty of today's market and kind of how can you navigate, risk management in real estate?
Well, I think some of the old school techniques are the right ones. Diversification, getting a certain percentage of your income in income, not just capital gains. It sounds old fashioned, but when you have interest rates that are as high as they are today, you might as well use it to your advantage. You can get good municipal bonds that are getting 6% kind of yields, and that's tax-free money. That's the equivalent of a 9-10% yield elsewhere, and that's pretty good. And historically, if you can get anything over 7%, that's a terrific return. So I would say diversification of your yields, of your returns, not just looking for cap gains, but also looking for income, particularly when interest rates are high. Today is number one. But number two, if you're investing in real estate, I would be looking at also diversifying. And the beauty of REIT investing is you get a little bit of both worlds, because REITs are generally speaking pretty high dividend paying stocks relative to the average stock. So you can get a little bit of income too. So I would say, look, if you're a small investor, there's plenty of great companies in which to invest, diversify, but get some portion of your return in income.
Spencer, what do you think? I mean, technology. I feel like real estate's really far behind on technology a lot, but it's trying to play catch up. How do you see the role of technology playing into commercial real estate? That's a big question, but how it's managed, how it's marketed, how it's valued, how brokers interact, all that kind of stuff. How do you see it? And take it whatever lane you want to go, because that's a really big question. But how do you see technology playing a factor?
I'll simplify the question into two aspects. One is technology allowing you to manage existing assets. And then the second type of technology is its ability to predict what types of assets you should buy or build. And so in the first category, the property management, asset management tools, I'm not saying we've reached the singularity of perfect information. I am saying that we've reached close to that when it comes to the Internet of Things within existing buildings. That if you look up in your building, even in your house right now, I happen to be in a hotel, so I'm now looking at the walls, and you say, oh, there's no Internet of Things in this room. I'm like, yes, there are. There's the fire detector. There's the television. There's the phone. There's a dozen devices in this room you don't even know are there that can measure the heat. Am I here? The noise level. So it's all, we're not quite there yet, but as it relates to the Internet of Things within physical structures, we're almost there. Not at the point of perfection, but we're getting very close to perfect measurability. As it relates to the predictive capabilities, we're nowhere. And I say that probably a little bit too strongly, maybe a little bit tongue in cheek. I had a terrific debate with my global chief economist, Richard Barkham, on my taping of my show, The Weekly Take, this week. And we were debating this. I'm like, look, how do we predict? And prediction is really, to me, the key area that's missing within real estate. And it quite candidly, it might always be missing, because you're like, oh yeah, I'm going to use this tool to say I'm going to build this industrial building on this corner by this site, or this office building. You know how many people have told me, like, oh, my model is 85% accurate. Well, a lot of those people were in the office trades. Well, it didn't really work out, did it? And too much reliance on bad modeling is worse than no modeling at all. I think that our ability to predict value over the long term in commercial real estate is still at the very beginning stages. The algorithms and other tools that we use to predict the movement of people, the creation of jobs. There's so many variables at play. I'm saying you can't put them all into a spreadsheet. What I am saying, though, it's not as good as the whim sometimes of a CEO or a billionaire that wants to become the backer of a place that you didn't expect. I'm sitting here in Detroit right now, and thank God for a lot of the great work that some very high net worth individuals did in downtown Detroit. Yeah. Dan Gilbert. Thank God for the work the Ford Motor Company did with the Innovation Center. Thank God for General Motors. I mean, these are folks that are saving this city, and they didn't have to, right? And people would have written off Detroit for dead. Well, guess what? Downtown Detroit is a great place, and I'm probably going there tonight. Is a place that you would not have predicted using any model 10 years ago.
Yeah. Yeah. I think a lot of it to me is on feel, right? It's that going for a walk in the neighborhood or going for a run in the neighborhood. It's driving around instead of taking the freeways, right? It's somebody told me too, somebody said, hey, look for where the artists are moving, and so I did that. I've done that before. And so it said, hey, the artists are moving to this neighborhood, and I've done really well in those neighborhoods. And so I think just some of it's just that lick your finger, stick your finger up in the air and say, where's the wind blowing today? That is almost as predictable as some of these models that you're going to look at. I mean, certainly we look at models, right? Don't get me wrong. I mean, we're trying to find out the trends and what's happening and what's going on, but it's a big time feel too. It's funny. I didn't invest in Detroit, but and I should have, but I was sitting in a meeting probably about 12 years ago now, and with a guy who had a lot of money, and he said, where should I invest in the US? And I said, Detroit. And he's like, that's the stupidest thing I've ever heard.
Well, let's be clear here.
There's certain
was
areas.
Representing many of the large investors who had done some investing in Detroit before the global financial crisis, and they will never come back here because they lost a lot of money. But it's a psychology thing, not dissimilar to the psychology thing that knocked retail down for a decade, not dissimilar to what we're seeing as a psychology thing of knocking down office today. I mean, you're crazy to go to Detroit. You're crazy to buy retail. You're crazy to buy office. Well, you know what? Math and predictability of where people are, where they want to be, should be your driver, not losses you incurred a decade ago.
Yeah. Yeah. Or losses somebody else incurred, even worse. And I hear that over and over. That's crazy to be doing that. When I was buying single family homes right out of the GFC, 2008, people were like, you're crazy. That is the stupidest thing you could do. Well, it's because they just got foreclosed on. Of course they thought it was crazy. And I agree. The same thing with retail, same thing with office. Office, you can buy the right office in the right location and you'll do well still.
Well, then you also have the opposite phenomenon. I say this with love to my life science investor clients. I was on the phone with one of them yesterday. Look, there was a bubble in life sciences that formed post-COVID, where people thought because of the terrible tragedy of COVID, life science is going to be the next big thing, and people overbuilt it. And then the VC capital dried up when interest rates went up, and you had this double whammy of too much supply and not enough demand. And so life sciences is going to be digging out of that hole for a while.
Yeah. Yeah. Spencer, I want to be respectful of your time. I know you're a busy guy, so I got a couple last questions and then we got to wrap up. So what's a big lesson that you've learned in your career at CBRE? How could it benefit, my listeners?
Be a lifelong learner. I read 4 or 5 newspapers every day. I read everything. I talk to everybody. And when I say everybody, I'm not just talking to business leaders. I'm talking to the people that are driving the car. I'm driving behind the desk. I'm talking to just ordinary folks because I want to know what's really going on. And I learned a lesson about that from one of the guests on my show, Belinda Roman, who's a professor at St. Mary's University in San Antonio, who, by the way, and nobody knows this, was the #1 forecaster in the United States last year, according to the Wall Street Journal. How did she get that moniker? By doing exactly what I just said. You look at the models, you read, you speak to the experts, but you speak to everybody else too. You need to know exactly what's going on from a macro and micro standpoint, synthesize it, and then act upon it. The last thing you need to do even though so many people do this, and this is many of my clients, I'm not saying this in a disparaging way, is over reliance on the financial modeling. Because what happens is nobody is smart enough to know whether on the going in, the cap rate is within 25 or 50 basis points of what you're paying. And nobody's smart enough to know whether it's 25 or 100 basis points on the back end either. Where you are smart enough is to look at all the tea leaves of where are the positive trends going. Am I a good operator, asset manager that's going to maximize the value of this? That you can control. You can't control a lot of the minutia at the beginning and at the end from a capital markets perspective. But if you look at it that way and really focus on the big picture trends, I think you'll be more successful over the long term.
Yeah, couldn't agree with that more. What do you have any? What's a contrarian view? Like something that you hold that in commercial real estate that maybe other people would either disagree with or be like, wait a second, you have any of those?
I do, and I said some of them on this show.
Yeah,
I
you've
believe
already said a
strongly
few
that
things.
secondary and tertiary markets with multifamily is where to go.
Yeah, that's
and
true.
my institutions are like, la, 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 can't hear you, hang up the phone. I said the same thing about retail 6-7 years ago. La, 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 hang up the phone. They should have gone there.
Yeah.
So no, I don't always get it right. I was wrong on inflation. Okay. I'm not shy about the places I get it right. I'm not shy about the places I got it wrong. I thought because of the aging demographic globally that we'd have lower inflation forever. Well, something happened on the way to that dance. And the bottom line is, we have to adjust accordingly. But I think credibility comes from calling it how you see it, having a defensible argument, even if you get it wrong.
Yep. Yeah, and admitting when you get it wrong too. Right.
Which is something not a lot of people do.
It's hard to do sometimes. All right, Spencer, look, really appreciate your time. I want to let you go. How can people reach out? How can people learn more? I mean, CBRE's got a lot of stuff that they offer. So how can people get in contact?
Sure. So first of all, really appreciate, Todd, you having me on your show, I guess. And this is a terrific show. I would suggest listen to my show as well. If you want another perspective, The Weekly Take, very easy to get, The Weekly Take at CBRE. Yep. And that's number one. Number two, we have terrific research reports, and I'll just plug a couple of them. I'd plug the most recent Tech 30 report, which is a report written by my friend Colin Yasakochi, and it talks about the 30 sub-markets that are the hottest sub-markets in the U.S., because there's a lot to learn there, because many of them, Todd, you basically described to me on air. They're a large arts community, a large restaurant community, those types of things that you don't typically associate with the business community, but they often are the driver.
Yep. Love it. All right. Well, Spencer, again, really appreciate you joining us, and you have a fantastic rest of the day.
All right, Todd. Thank you.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.